Everyone is talking about silver at the moment, first of all because of the big rally we had in the end of last year and beginning of this year, and second of all because of the crash we had a few days ago. I see many people on YouTube, X and TikTok who say that this is just a correction and the rally will continue very soon. I don't think so, and I will prove all of those people wrong by facts. As you can see, I prepared a lot of things in the background. I prepared a lot of facts and statistics and data sets for you so that you can look at it on your own and not just believe what any guy on YouTube is saying. You should take a look at it, and in this video I will walk you through and tell you those facts I collected to say that this is just the beginning of the end. I believe silver will drop even more, and I'm saying that even if it's against me, because I invested 6 figures of my own capital into silver below 50. So I bought at a really good price. At that point of time, I felt like the king. I thought I'm the best trader in the world, and I smelled something what all the other people can't smell and see. And then the correction came, or the so-called correction. For me, it's just the beginning, as I said. And in this video, I will also tell you if it's smart to hedge with short positions or even just in general open short positions. To get an understanding of what is happening here, we have to scroll back into the past. I will go into the weekly time frame because what is happening here happened already twice with silver. We can see here, first of all, 1979 and 1980, we had the exact same pattern. We had an extreme rally and then an extreme drop. Interesting. And then we had the same thing 2010 or 2011 here. Extreme rally and then the drop. And now we can say, okay, those are just 2 examples, but now it looks the same. But looking the same is not a reason for me to say, oh, silver will drop or this is not a correction. We need facts. And I prepared those facts for you, and let's walk through them together. We begin with this time. What happened here? And to get an understanding of that, we will go through these papers I prepared. You can just read through them. You can stop the video if you want to read through something. I could send them to you guys if you want to have them. Let me know in the comments. This is my research paper. And we have a case study here for 1979 and 1980, the rally plus crash. Here you see a picture of those rally. It started here, and that was the peak. And then we had the end of the crash. That would be the beginning of the crash. There are some basic information, but what is interesting for us are the verified rally drivers, time aligned. This is important. We don't need news like, okay, the demand was high. We need time aligned data, which we can put onto the chart and say, okay, on that date, that news came out, or that was the fact at that date. And we have those things here, and as I said, they are verified. If you want the sources, also in the document, there are all of the sources available, because I want to work professionally and not just saying some things. So what do we see here? We see concentrated accumulation and leveraged long exposure by large participants, most prominently the Hunt Group. What does it mean? They opened a lot of long positions at that time. What time are we speaking about? About that time. So they opened a lot of long positions and even started leveraged positions. They used derivatives, futures, whatever, to go long in silver with leveraged positions. So they had a big impact on the demand on silver. And also there was a little concern about the inflation at that point of time. You can see here high inflation concerns, and many people took precious metals as an inflation hedge. So the demand from the public was also there and other participants. It's not only the Hunt Group, which bought insane amounts, but they were the main factor at that time. They were just buying. They bought so much that it increased the demand for physical silver and derivatives just by them buying it. And then also, as I said, the inflation concerns and the other people jumped onto the train, and that was the result. We can see here the market went up, and right now it looks like a meme coin. And everything that flies high will fall down at some point of time. But we need a reason. We want to understand, why did the market just drop? And why did it drop so far? We also have the verified crash drivers for that. What are the verified crash drivers? The verified crash drivers are exchange interventions and trading restrictions change the market regime. The SEC report documents emergency exchange actions, including trading restrictions such as liquidation only around the peak, which mechanically forced position reductions and reduced marginal buying capacity. What does it mean? With my own words, we will do everything very easy. So there could be some mistakes which are not actual mistakes. I just try to explain more easy to you guys so that you can understand it, which would not be in fact correct by the terms of futures trading and margin requirements, but I will just use it for showcasing you how the whole thing is. And at that case, the stock exchange, or the exchange, not stock exchange, but the exchange said at one point of time, okay, we increase the margin requirements and we make a restriction in there, and the restriction says liquidation only. What does this liquidation only restriction mean? That means that you're not able to buy at that point of time. What happens if you're not able to buy, or people are not able to buy? You start selling off. Where do you sell off? At the next available price. Where's the next available price? Wherever you are allowed to buy. And this was not at the peak, as we can see here, around the peak. And that forced the people to reduce the positions, like cut them, or just started to make people think about selling, since it's not possible that the market can go further up without the ability to buy. And that was one of the restrictions the exchange made. And then everything went its way. The positions were sold off, margin calls went in, and the whole thing dropped like a stone because of that thing. And if you want to ask me, so tell me what was the reason? The reason was the intervention of the exchange, because they made a restriction saying liquidation only. That means you can just sell, not buy at that price range, and that caused the sell off, and that caused the drop of the whole thing, because when it sold, some other people got margin calls. Margin calls means sell. Sell means it's more supply than demand. More supply than demand means drop. So even if it was just the beginning on top, everything fell further down because it was a reaction on each other. If situation 1 is going to be started, then situation 2 will be activated by the end of situation 1, and that forced the market to drop that far. So that's really interesting, because the key point here is margin. Margin and exchange regime change. Let's call it like that. But you will understand more of it if we go further to another example. Let's go to the other case study, 2010, 2011, where we had the same scenario. The markets went up heavily. You can see it here. Looks like a meme coin again, went up, 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 up. And both have one thing in common. Look at that part. We have a little correction here, about 15% from here to here. We also had the same thing at that point of time. I don't know if it's 15%, but should be probably. Yes, you can see 11%. So there is a part which puts them also together besides just the rally and the crash. They look the same, so could be twins. And we see here the market went up, 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 and then in May or end of April, the market just dropped. The same as we saw it in the past and the same as we see it now. What was the cause for that? We can go down and check first of all the verified rally drivers, also time aligned. And the main rally driver at that point of time was the quantitative easing program by the Fed. So that was the main driver, because that caused big investments in silver, and also some drivers were also how is it called here? I have to check the solar related parts. Yes, because that was the time where solar energy got prominent, and they started working on that, investing in that. And for that area, physical silver is needed, which obviously causes the demand to go up, even if the supply stays the same, and that results in higher prices. But that is not the real part. That is a small part, let's say it like that. That's a small part. The main part is the QE. which was made by the Fed, and that caused this rally. And then the small investors jumped obviously on it. Everything what is going up, the small investor thinks, okay, we can make a lot of money now. I can just be quick and make some money. Not working, Habibi. That's not how it works. And then the verified crash drivers, time aligned. What happened? What caused the crash at that point of time? We can check. First of all, repeated exchange margin performance bond increases on COMEX silver futures in late April, early May 2011. Mechanically raised the cash requirements to hold leveraged positions. We see here late April, early May 2011. What does it mean? That means that we have to put more money into the position. Take this bottle. I don't know where you live. If you live some other parts in the world, in Germany we have a system called Pfand. What does Pfand mean? Pfand is deposit. In Germany we have deposits on plastic bottles. If you buy this plastic bottle, you pay 25-cent deposit, and if you return it, you get that money back. It's a deposit, right? And now you have to imagine the same thing with the bottle. We buy the bottle for the price, for example, $42, and the deposit is amount X. But if the exchange is telling us to put much, much, much more into the deposit, we will probably not buy anymore because it's getting expensive to buy. Not expensive in terms of the price, expensive in terms of we need to put so much money in to get a certain amount of gain. We take that bottle costs €1 or dollar, wherever you live, $1. But the deposit for it is $10,000. Would you buy this bottle? Probably not, because you have to put a lot of your capital into buying that bottle and you don't want to buy it anymore. So that was the change they made at that point of time. They said we increase the margin requirements. That means you have to put more, let's call it deposit, into that as a security, which makes the whole trade much more expensive. Not price-wise, just investing-wise. For example, you have a portfolio of $10,000, you want to invest a bit in silver, but all of your portfolio money needs to be a margin requirement. Then you can't invest in other things, and that's not even worth it. So you don't invest in silver. And that also causes people to sell, because if you are in an existing long position, the problem is you still have to put the capital in. If you have the bottle already, they say you still need to pay a bigger deposit. And then the people were forced to sell since they don't have the money or they can't put the money in, whatever. There were many reasons. So they shorted their positions, not shorted in terms of going short, but they just cut them. That's the better word. They cut big parts of their positions and said, okay, I can't afford to go long even more or to hold the long position. We just sell now. And that was around the same day, because when that rule came in, everyone had the same problem. We need money to keep that position, and other people can't buy the position. Like, even if you sell, you need a buyer. But if the buyers say, oh, much too expensive to buy right now, you can't find a buyer. That means the market drops until they meet buyers at a price where buyers are willing to buy. So those were the crash drivers in 2011. And then also additional margin adjustments later in 2011, including September, are documented. And there you can see what's happening here, another crash. So the margin topic is a really important thing in the silver market, or in every market, but for those silver crashes, especially when we see those rallies we saw in the past in 1979 and in 2010, when we see rallies like that, and then the margin requirements change or some regulations come in from the exchange, then that will have a heavy impact on the chart. No fundamental data, nothing can save you from that, because if it's too expensive to hold, the fundamental data can as strong as they want to. If it's getting too expensive, the people will say no. So we continue to the current situation. Welcome to 2025-26. This is where we are right now. Take a look at that. We got a big rally. So we want to check what were the verified rally drivers at that point of time. And there is a structural deficit narrative. So many people think that there is not enough silver. The supply is far below the demand. This is like the natural thing for prices. Then we still have the industrial demand. still solar, and the macro context, which means some dollar related and interest rate related things, which made investors think, okay, this is a good invest. And this is also where I invested, because I think, the situation looks pretty good. The fundamental situation is fine. Silver seems to be far undervalued compared to gold. So mashallah, let's take it. It's a good invest. And I was right. I bought somewhere here. So I was pretty right with my decision. And it went up, 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 up. At that point of time, the 29th of December, a decision came in. Let's take a look at that. What can we verify about the crash triggers so far? And we see here, verified microstructure shock, CME clearings, raised performance bond, margin requirements for COMEX silver futures effective on the 29th of December. Now you ask yourself, okay, but it went up again. Yes, because they raised the margin requirements, but at that point of time, the people still said, okay, the raise of the margin requirements compared to the potential value of silver is fine. I'm okay, because if I think that bottle is really worth it and I have my base data for that, then I say, okay, then it's okay to deposit a bit more. For example, if you go into an apartment, I moved into that apartment here, I had to pay a bigger deposit than people in other apartments because this is a nice apartment. Let's call it like that. We have marble stuff and whatever. So they said, okay, we need to give you a higher deposit because the value is higher. And everyone accepts it and say, okay, yeah, the value is higher and it's okay to do a bigger deposit for that. Then the market will continue. And that's what we see here. So it's no extra data which made the market go up. It's just the comparison of, still worth it or not? Yeah, still worth it. And this is what happened here. So it ran up, 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 up. And now we come into a mechanism which is really important to understand. At that point of time, the volatility was extremely high. You can measure out what the average movement was in a day. So if we check it here, it's nearly a 15% movement just on a daily base. That's extreme volatility. Check on that candle. It's just a normal candle, but it's 15% movement, which looks like a few percent. It looks so normal, but it's not normal if the volatility or the movement of a day is 15% of the value of its asset. That's horrible. So the volatility is extremely high. And at that point of time, we had so high volatility and an all-time high. And there is a mechanism, which will be interesting if we take a look at it now, that if the volatility is too high, that the exchange will raise the margin requirements. And this is what happened here. It did not happen on that day. That's the funny thing. Because if you take a look at it, we think, okay, then probably based on the events that happened in the past, this is the day where the margin requirements were raised. No, that's wrong. This is the day where people realized the volatility is so fucking high that the raise of the margin requirements will probably come. It's not safe, it's not guaranteed, but in most of the times, if the volatility crosses a certain amount, it's nearly easy to say that higher margin requirements are about to come. What is the problem with higher margin requirements? Silver will be more expensive, even more expensive to hold than we had before here. And will be just more expensive to hold. People will sell because they have to put in cash. So they predicted it this time. They said, okay, the volatility is too high. The margin requirements will come. We better sell now before it's too late. And then that happened on the 30th of January. And what we see then is on the 2nd of February, I guess, here, margins rising again. That means after the 2nd, after Monday, the margins rised again, which said, okay, because of the volatility, nothing special. So it didn't drop at that day that far since the move came already. Everyone expected it, the big players. And on that day, they said, okay, fine. And then they expected it to go up since everything was priced in already. But the truth is, it's still extremely, extremely, extremely expensive to buy silver. And my prediction now is that it's very hard to predict. Let's go through the facts. So these were the key points why it dropped. It was people priced it in already. And we can go to the verified drivers and status. What put the market at the all-time high? That were the structural deficit, verified and still intact. Then we have the industrial demand. It's mixed, so we can't verify it, but it's weakening, or there's the risk of weakening. And you can read through it on your own. Look at it, pause the video, read through it on your own. We see that there are some verified sources, but they are weakening. It's getting down. And the comparison to the costs of buying silver is bad now. So people think the demand is not that high as it has been here, and it's even more expensive to buy silver. So in my opinion, we will not reach that top very soon. I don't believe in making a new all-time high within the next days or weeks. I don't think so, because it's still extremely expensive to buy silver, and the demand of it dropped since then, or there is a big weakening risk. So, and also those data is lagging. So we don't know about it till today. It's not a fact today. We just know it based on what we can see here, 3 months and all that shit. So 3 months change. It takes time till we get the real data. And I think this is where we will be just sideways or even drop. If you are, as me, invested in a long, it could be nice to open some shorts to hedge the position, since I'm not expecting it to go to a new all-time high within the next days or weeks. I don't believe that. I think it could even go lower, since all the dumb money is also in there. Every idiot is buying silver right now, and that's the problem. So I don't believe in rising silver prices at the moment. That's how I see it, and that could cause more drops. And oh wait. Okay. Yes, and that could cause a drop. So I don't believe in it's going up within the next days or weeks. If you have any questions about this analysis, let me know in the comments. I will be happy to answer, and let's see what the market is bringing for us in the next days.